Section 22, reckless trading is prohibited. Look at all those exclamations next to the NB, guys. This is a massive topic. It's going to come up in your test or in your exam. It's coming up some point this year. So it's really important to get a thorough understanding of it. What is it? If you carry on your business recklessly or with gross negligence or with the intent to defraud or for fraudulent purposes, or you are unable to pay your debts as they fall due, then you are carrying on your business recklessly, and that is prohibited. As soon as you are doing any of these, you have non-compliance with the Companies Act. And we'll learn at a later stage, but I want to put it in here. As soon as you've got non-compliance with the Companies Act, you have a reportable irregularity as determined by the Auditing Profession Act. Huge problems here. So guys, in a question you've got to look for, does this seem recklessly that they're doing this, or are they intending to defraud someone? Often here you will see this in a question where they are plagiarizing, or where they are maybe changing expiry dates. Anything where you can see that they are trying to mislead people, they're intending to defraud them, or for fraudulent purposes, it's an illegal business. They are acting recklessly. The most common way in which they are acting recklessly is that they are unable to pay their debts as they fall due, and I've put it here for you to see. That means current liabilities exceed current assets, which means they are not liquid. And so we've seen the liquidity test. We have to do that in certain decisions. Here is now very crucial that whenever you get a set of financial statements, you always go and look at whether they are liquid, because if they are not, it indicates reckless trading, non-compliance with the Companies Act, a reportable irregularity. We have massive going concern issues in this case. Let's quickly have a look at the standard. Section 22, a company must not carry on its business with gross negligence, intent to defraud, recklessly, or for any fraudulent purposes. And down below it says, and if they are unable to pay its debts as they become due and payable in the normal course of business. If they are found doing so, then the company has 20 business days to satisfy to the Commission that they are not engaging in reckless trading. And only then can the Commission decide. If they believe that they are, then the Commission can tell them to cease trading. Section 24 and 28 is just dealing with the company records and accounting records. And just a few points here, guys. You must maintain them for 7 years, so that if anybody ever wants to challenge you, within 7 years, you could be held liable if you cannot prove your accounting status or records. And guys, they must be accurate and complete. So whenever we can prove that there are misstatements and they don't want to adjust, and we can therefore see that they are not accurate or complete, we can once again say non-compliance with the Companies Act, potential reportable irregularity. Okay, so once again, IFRS now gets brought into the Companies Act. Moving on from that, the financial statements and annual financial statements. So just to see here that Financial statements must be prepared in accordance with the financial reporting standards or framework. So for you guys, it will be IFRS, because that's what you do in accounting. And note this, every company must prepare annual financial statements within 6 months from their year end. So whenever we're looking at auditing and there's deadlines and so on, it's because annual financial statements must be prepared within 6 months. And guys, those annual financial statements must include the auditor's reports if they have to be audited. That's why deadlines come into play. Okay. Who has to be audited though? All companies that are public must be audited. So whenever you see the LTD, you need to make that note, they need to be audited. And if you see in a question that they're public and they're not audited, once again, we've got non-compliance with the Companies Act immediately. They must be audited if they meet the requirements of the public interest score, which we're going to look at next. And then, if they choose voluntary selection to be audited, and it's therefore included in their memorandum of incorporation, they have to be audited. They cannot decide, no, they don't want to next year. If it's in their MOI, they have to do it. If they don't want to do it anymore, they're going to have to amend their MOI so that it no longer is voluntary selection of auditors. Okay, let's look at that public interest score. This sits in Regulation 28.2. Guys, the regulations you will find at the back of your Companies Act. Okay, so get your Companies Act, go to the back, you get your regulations, and you're looking at 28-2. These are the companies who have to be audited. Public, we've already just looked at. And now it adds state-owned or non-profit. So those two now are included. Any company that in its ordinary course of business holds assets for non-related persons that at any time during the year exceed 5 million. So guys, these would be like your banks and your financial institutions, because they will hold assets, rands, money for clients in excess of 5 million at any point during the year. Okay, so non-related, so all we're saying is that if they are doing it, or if a company is holding assets in excess of 5 million for their subsidiary, then they wouldn't have to, okay, because they would be considered related. And now we get the public interest score requirements. Any company whose public interest score is 350 or more, so 350 is included, and the annual financial statements were prepared externally, so they actually had somebody else prepare them, or if their public interest score is 100 or more and their financial statements were internally prepared. Okay, so how do we work out that public interest score? Your Regulation 26.2 will tell you it is the number of points equal to the average number of employees during the financial year. So it's average, guys. You need to look in the question to see average, and if they don't give you average, but they give you the number at the beginning of the year and the number at the end of the year, then you need to add those two up, divide it by 2 to get your average. 1 point for every 1 million or portion thereof in third-party liability at year end. So, third party, again, non-related liabilities. So 1 point for every 1 million or portion thereof, which means, guys, if you have 10 million and 1 rand, this 1 is a portion thereof of a million, so I'm going to give 11 points. I give 1 point for every 1 million, so there are 10 millions there, 10 points, and then I give another point for every portion thereof. So it doesn't have to be a big portion. if there is any number that follows this million, any number here that follows, you will give 1 point for it. Okay, so if my number was 9,900,000, then I'm going to give 9 points for the 9 million, and here is a portion thereof, so I'm going to give 1 here, which means I'm going to give 10 points. Okay, 1 point for every 1 million or portion thereof in turnover during the financial year. So once again, what is their turnover? If they're sitting with a turnover of 900,080, then I have to give 1 point, because this here is a portion of a million. Okay, it's any number that goes over the million but doesn't clock into a new million, it gets a point for it. And then 1 point for every individual at the end of the year who is a shareholder. So I've got to look at the number of shareholders at the end of the year, and that's how I add it up. So guys, there's a calculation here. Finally, we have some calculations in auditing. And we already know when we get a set of financial statements, we need to look at the liquidity and solvency, specifically for the going concern. We also know there could now be a materiality calculation, because if they give us the figures, there may be numbers that need to be done. And now I need to add in, maybe there's going to be a public interest score calculation. But I would only consider this if they are private and I am looking at whether they need to be audited, or we'll see later, if they are public and listed, then there is a criteria that says they would have to have a social and ethics committee. All right, let's go into the regulations at the back of your Companies Act so we can see this, because you will need to use this in a test or exam. So you'll have a regulations content page. We're looking at companies that need to be audited, so Regulation 28. And it states here that public companies and state-owned companies have to be audited, and then it gives some additional. If in the ordinary course of their primary activities they hold assets in a fiduciary capacity that exceed 5 million rand. And then any non-profit companies, and then finally any other company whose public interest score is 350 or more, or at least 100 if their financials are internally compiled. Regulation 26. This is now going to give us the calculation for the public interest score. So if we go to part 2, it says, here it is, we need A, the average number of employees during the financial year, 1 point for every 1 million of third-party liability, 1 point for every 1 million of turnover or portion thereof, 1 point for every individual who has a beneficial interest or member in the case of a non-profit company. So let's have a look at a quick example. I'm going to give you guys 5 minutes here, although you don't need 5, but just because it's new, to do this question.